Welcome to this explainer. Look, if you've ever stared at a company's financial statements and felt like you were trying to read ancient hieroglyphs, trust me, you are not alone. It's just a wall of numbers. But today, we're going to transform those raw financial statements from intimidating data into a clear, actionable diagnosis of a business's health. And we're doing this using the absolute magic of accounting ratios. You can kind of think of these ratios as the medical instruments we use to check the vital signs of any company. They reveal the true story hidden right beneath those balance sheets.
So here's the agenda for today's health check. We'll start with profitability, making real money. Then liquidity, actually paying the bills. And finally, efficiency, those day-to-day operations.
All right, let's jump right into part one. Profitability, making real money. To really ground these numbers in reality, let's look at a real-world example. I want you to meet our first patient, Sally. So Sally is a sole trader who buys and sells beautiful, intricate antique jewelry. Her business looks super glamorous from the outside, but, we need to know what's happening on the inside. This is the core indicator that tells us if the underlying business model is actually pumping life into the company or if it's kind of just spinning its wheels without generating real value.
We'll kick off our health check with the gross margin. This is an absolutely foundational ratio that analyzes the profitability of our sales directly from the trading account. It basically takes the gross profit, divides it by the total sales, and multiplies it by 100 to give us a nice clean percentage. Essentially, it's telling us exactly how much money she's making on the actual items themselves, way before overhead kicks in.
Looking at this simplified data straight from Sally's income statement, we can see exactly how this works in practice. So we've got our total sales at $3,000 and the cost of buying that jewelry at $1,400. That leaves her with a gross profit of $1,600. To calculate her margin, we simply divide that $1,600 gross profit by our $3,000 in sales.
And this brilliantly illustrates what we call the rule of 100. Because her gross margin comes out to 53.33%, it means Sally makes a really healthy $53 of gross profit for literally every $100 of sales she generates. I mean, that is an incredible start. It shows her core product has a very strong markup.
But what if she wants to push that even higher? Just think about it for a second. If Sally wants to improve this margin further, what do you think are the potential adverse effects of simply, say, increasing her sales promotions or expanding her product range to grab more revenue?
Well, it's a really delicate balancing act. The reality is, if she aggressively increases her selling prices to boost that margin, she might just drive her loyal customers right out the door. On the flip side, if she tries to artificially inflate the margin by drastically reducing the cost of sales, maybe by finding, cheaper suppliers, she could severely compromise the high quality of her antique jewelry. Sure, the numbers might look better for a minute, but the business would ultimately suffer. Now, we really need to note the distinct difference here between gross margin and profit margin. While gross margin looks at the markup on the goods themselves, profit margin actually subtracts all the everyday operating expenses. We're talking things like rent for her shop, electricity to keep the light shining on those diamonds, and her own salary. This is the true bottom line.
So after factoring in those necessary expenses, Sally's profit margin drops down to 21.67%. What you should really take away from this is that her operating expenses eat up roughly $31 of every $100 in sales. She is still profitable, making about $21 per 100, but wow, it highlights just how much it costs just to keep the doors open, right?
The final profitability check on our list is ROCE, or Return on Capital Employed. This ratio is absolutely crucial for owners and investors because it gauges how efficiently the business uses the total money invested in it. You just take the profit before interest and divide it by the capital employed. For Sally, this ratio sits at a modest 4.47%. It tells us exactly how hard her invested dollars are actually working for her.
All right, moving right along to part two, liquidity, paying the bills.
Shifting our focus from long-term profitability to immediate, short-term survival, the absolutely critical question we have to ask ourselves now is, are there sufficient liquid funds to pay the bills right this second? Think of it this way. If profitability is the heartbeat of a business, liquidity is its immediate blood pressure. It's all about the here and now. If a supplier comes knocking today, can the business actually open its wallet and pay?
The current ratio measures exactly that. It simply compares current assets, which are things that will turn into cash within a year, against current liabilities, which are the bills due within that exact same year. For a healthy business, you usually want to see an industry average somewhere between 1.5 to 1 and 2 to 1. Basically, this means you have a really comfortable buffer. But
Sometimes we need a stricter test. When we compare these two metrics side by side, it becomes instantly clear that the only difference between the current ratio and the liquid ratio, which is often called the acid test, is the subtraction of inventory. Why do we remove it? Well, because inventory is 2 whole stages away from actually becoming cash. You have to find a buyer to sell it to, and then you actually have to collect the money from them. In a pinch, a warehouse full of inventory is definitely not going to pay the electricity bill.
Applying this back to our patient, Sally, her current assets set at $12,800, and her current liabilities are at $5,800. This gives her a current ratio of a very safe 2.2 to 1. And actually, this is perfectly normal because antique jewelers intentionally hold a lot of expensive inventory. All those gems and gold pieces make up a huge chunk of that asset number.
But here is the real proof of her financial health. Even when we perform that super strict acid test and strip her $2,500 of inventory completely out of the equation, Sally's liquid ratio remains a highly robust 1.78 to 1. This is well above the desirable 1-to-1 baseline. It means that literally, even if she couldn't sell a single piece of jewelry tomorrow, she still has more than enough cash and immediate receivables to cover her short-term debts. No sweat.
And that brings us to part 3, efficiency, day-to-day operations. Now we're looking at the day-to-day metabolism of the business, and a key indicator here is the rate of inventory turnover. This reveals how many times a business replaces its stock over a given period. Let me tell you, a low rate is a massive red flag. It means old stock is just piling up, gathering dust, and crucially, your cash is unproductively tied up in a warehouse somewhere instead of being used to actively grow the business. Let's bring in a new patient to look at a slightly different kind of efficiency. Meet Yolanda. We are going to look at her trade receivables turnover ratio, which basically measures how long it takes a business's credit customers to actually pay off their debts. Looking at her numbers here, she has $100,000 in credit sales and $30,000 sitting in trade receivables.
So, the crucial point is, when we run the math, Yolanda's turnover is roughly 110 days. Think about that for a second. That means she is waiting almost 4 whole months for her cash after she makes a sale. This is a dangerously inefficient metabolism that requires immediate credit control policies. You can be highly profitable on paper, but if your customers take a third of the year to actually pay you, you can easily go bankrupt just from a lack of cash flow.
Conversely, we have Olga. For her, we're going to use the trade payables turnover ratio to evaluate how efficiently she manages the money she owes to her suppliers. She's got $50,000 in credit purchases and $5,000 in trade payables.
When we crunch the numbers for her ratio, we see Olga pays her trade payables in about 37 days. Honestly, this is a brilliant strategy. It indicates she takes full, efficient advantage of the trade credit extended to her, meaning she gets to keep her own cash longer, while she's likely still securing lucrative cash discounts from suppliers for paying within a standard 40-day window. She has a highly optimized financial metabolism.
As we wrap up this explainer, I want to leave you with this final thought. We've looked at profitability, liquidity, and efficiency today. They are all deeply interconnected. If your business, or maybe a company you were looking to invest in, was the patient on the operating table right now, which of these vital signs would you need to treat first? Understanding these ratios gives you the power to actually find that answer. Thanks for joining me, and keep diagnosing those numbers.